Hello, everybody, and welcome to our 2020 planning webinar. My name is Ron Feldman with ApplePie Capital. My co-presenter today is Randy Jones, our Head of Originations, and we want to welcome all of you. We're hoping to cover a lot of ground here today. It'll take the next 45 to 55 minutes of your day, and hopefully you'll find it of value. Just want to cover a couple of housekeeping points. Everyone is muted so that we can have a quiet sounding conversation. If you do have questions, there's an attendee chat function. Please type them in there. We will try and address them if possible in real time. If not, we'll get to them at the end. We do have all of your pre-registration questions. We will address all of those. To give you all an idea of what the audience looks like, there's over 40 brands represented. And 20% of you have over 4 units. 20% of you have 2 to 4 units. A bunch of you are startups, and a few of you with over 10 units. So, in multiple brands. So, we will be recording, or we are recording this presentation today, and everyone will get email the link tomorrow, so we can cover that. And with that, I will turn it over to Randy.
Thanks, Ron. So today what we're going to cover is the topics we'll cover would be how to determine when you're ready to grow, what are the requirements needed to add additional units, what's the first steps in creating a financing strategy or financial strategy, and what can you do now in preparation for adding units in the next year, and what's the best way to leverage our team to help you kind of accomplish your goals.
Oops. Before we get started there, we need to cover some macroeconomic factors. What we're seeing is the end of a cycle. It's a normal thing. What happens at the end of economic growth cycles is you see credit starting to tighten, which is happening. We have wage pressures because we have virtually no unemployment in this country, and we have minimum wage pressures in many markets hitting you all in ways that you didn't want to be hit. Our government is doing their best to not help us in a few states, California, New Jersey, and then there's a federal bill called the PRO Act, which would basically, if you've ever heard of the joint employer ruling, it would make the joint employer ruling the law. It's really bad for franchisors and franchisees. If you have questions about that, I suggest that you go to the IFA website at franchise.org. You'll see more than you want to read about it. And I urge you all to get involved with your legislators at the federal level to ask that they not support this PRO Act. And lastly, the R word. That R could be called recession. Recessions happen. They're sometimes good for franchising. Many times they're very good. People generally trade down in recessions. They still go out to eat. So QSR usually does well in recessions. The higher end type brands that are out there are probably going to have some challenges, but you just need to know it's happening, be prepared for it, get your financial plan in order, which is hopefully something you'll get some knowledge on today. But you really have to ask yourself, what does all this mean to your business? Again, if you have questions on these specific things, www.franchise.org is the International Franchise Association's website.
And so the impact of the recession doesn't necessarily mean that financing would be shut down. It just may mean that you may have to put more skin in the game, or you may have to, the banks may lend at a little less aggressive ratios than what they're currently lending to today. The outlook doesn't appear to be as bad as it was in the last recession, but there are things you need to plan for as you go through it. So, with that said, how to determine if you're ready to grow in 2020? Those of you that are in brands and you're relatively new to a market, you need to make sure that your concept's received well in the market and a new market for a brand. sometimes causes lenders pause. So you need to make sure that your trends are positive, the concept is received well, you're meeting projections that you thought you were going to hit before you opened. Ultimately, consistent margins and with wage pressure, et cetera, you may be seeing upward trends in your cost of labor, but those should have stabilized so that way you know how to predict what's going to happen in 2020. Similar to the cost of food, we haven't seen much commodity pressure in the last 6 to 12 months, but certainly that could be an issue for you. So consistent margins are really important to know that you have the stability to run the business. And then kind of going into the operations side of things, if it's the number of employees and still the labor costs are off because of the number of employees, you're still learning how to staff properly, et cetera, and is every day a fire drill. So learning how to manage your operations smoothly is a good predictor of being able to add additional stress and new units onto the location or onto your business. And then ultimately a good problem to have is if you have too much business. Sometimes your business is booming and you're busting at the seams and you have a wait list for your use, or customer counts are too high to satisfy them. So at that point, it's also a good time to consider adding another location.
So here are some questions for you to ask yourself. We always like to do some self-reflection when we're doing planning. First question is, what is my financial capacity for growth next year, next 3 years? Have I already invested all of my available capital, and do I need a partner? What is my operational capacity? To Randy's point in the last slide, can you leave your business and will it operate if you're not there opening a new unit? One of the big questions is there territory in your brand that's close enough for you to be able to effectively manage? How do I benchmark against other franchisees? Again, to Randy's point in the last slide, if your labor costs are 5 points higher than the other franchisees in your system, maybe you should fix that before you grow. And lastly, what is your succession or exit strategy? You need to have one. You can change it, but you really kind of have to be working towards something to figure out where you want to go and how you want to get there. So those are questions you need to ask yourself now as you're doing your 2020 planning, and kind of write the answers down, and it's just you're having a meeting with yourself. That's really what it comes down to.
So the next piece of that are the what ifs. And ultimately, again, to Ron's point, part of planning is to assess where you are today and where you want to be when you get older. And then you also have to look at the what ifs, the scenarios as you're going through planning. So what if I was able to buy units to double my size? There's a lot of acquisition opportunities out there within various concepts. So buying existing locations ultimately is a great path to grow, but what if it puts too much pressure on you, or do you have the capacity to handle that? Similar, what if I build 2 units and open them within 2 weeks of each other? Do you have the ability to handle that pressure? What if I get a few distressed units that are required most of my time management? And we all know that the drain of time and effort it is to turn something around, and do you have that capability and desire? And probably worst case scenarios, if you're in a distressed unit situation, it absorbs most of your cash flow. What's the backup plan in case that is the scenario that you're in? And how would any of these current situations, how would that affect your operations, and would it deplete EBITDA or resources to a point where they weren't manageable, or are you set up to effectively do that? So those are the questions you need to ask yourself.
So how you grow is one of the questions that you also need to consider. Growing organically, which is I want to build new units and I'm going to handpick my locations and I'm going to do the construction or manage the construction, and I want to be in 100% control of my locations and where I'm going to grow. That's a great strategy. It's not quite scalable unless you have a big team and a lot of money. There's a big downside. I don't want to call it a downside. We call it a flip side. It's probably the right term. That developing units is a completely different skill set than operating units. And there is a time and distraction effect on your existing operations if you're out there looking around the market for new units, getting permitting, getting construction done, negotiating leases and TIs, hiring and training staff. It can cause you to lose operational efficiency in your existing units. In fact, it will. It's a question of how much. So you need to understand that going in. Again, be prepared and know that you're going to have to deal with it instead of having it become a crisis. And then if you're and there's a bunch of people on the registration list that are in membership-based businesses where you don't cash flow for a year versus QSR where you're kind of cash flowing right away. If you're going to open a few of these units at the same time, you're going to have multiple sources of working capital drain on your operation. You got to make sure that you're strong enough to be able to support that if you're going to grow aggressively.
So what are the requirements added or needed to add additional units? Ultimately, you need to consider that you have equity into the future project. The equity could be in the form of cash or embedded equity that you have within the unit or value that you have within your current operations to help contribute to the equity contribution. Typically right now we're seeing 10% down payment for SBA and 20% conventional. As we kind of started the initial discussion in Ron's slide that he had previously, I would expect these to go up. I would expect over the next 6 to 12 months that these down payment ratios would look more to 20% down for SBA, potentially getting higher for conventional depending on the franchise operation or franchise concept and operations. So I would anticipate this ratio here to go in the wrong direction for you as we get closer to a recession. Liquid cash reserve, all of the questions that we asked you to kind of ask yourself, the answer to a lot of those is, do you have liquidity left over? And ultimately, the more cash you have left over, the more bumps that you can handle as you open new locations, et cetera. So minimum rule of thumb, if you're adding 1 or 2 units, would be 3 to 6 months of fixed expenses. If you're adding significantly more in a quicker pace, then more liquidity would be necessary than this. Current locations, the strength of your current operations, if you are an existing operator, should be roughly 1.25 debt service coverage, to put it in lender terms. In our language, really you need to be bringing in, for every $100,000 in loan payments, you need to be bringing in $125,000 of EBITDA, so to put it in more realistic terms or more real language for you all. And then debt to EBITDA is really the amount of debt, not the debt payment, but the amount of debt comparatively to your EBITDA. That ratio is typically 4 to 1. Some lenders are lower than that. Other lenders will be a little more aggressive. Obviously, probably the same answer applies. It depends on the franchise concept that you're in and what this ratio may look like. But general rule of thumb is 4 to 1. So if you have, again, $100,000 in EBITDA, the max debt that would be comfortable at this ratio would be $400,000. And then the global debt service coverage, so in other words, we're looking, the debt service coverage on your current locations was your business operations. The global debt service coverage contemplates your personal living expenses combined with your business expenses and your personal income combined with the business income. And that ratio also looks very similar at 1.25 times.
So a bunch of you out there, about 20% of you are startups, 0 to 1. What we've seen there and the pitfalls of doing this, first and foremost, if you haven't ever opened your own business, you've not ever applied for a business loan. We'll get to how we can help you with that, but you need to get help. You don't want to try and do it yourself when you're trying to get your first business loan. One of the big mistakes we've seen if you're in a multi-unit type concept where you want to open 3 or 4 is to use up all your cash in the first one. The FDD is just a guideline, and item 7 of the FDD, which outlines all the costs. When you see the bottom numbers on the FDD, that's just the lowest and the highest. 90% of the units that are opening could be opening in the high range. But so you don't want to take those 2 numbers and average them. That's not a good way to do it. You need to do that through franchisee validation and finding out what the current cost structures are. And then selecting the right financing source and path. We're going to cover that in the next slide. The big takeaway here is if you're in a growth mode, and that's what we're assuming here because that's kind of the title of this webinar is how to grow in 2020. You want to preserve your liquidity. Cash is king. Make sure that you preserve it so that you can A, have the working capital you need, and B, perhaps have some dry powder to do some expansion more quickly.
And just to build on one point that Ron mentioned in the franchise disclosure document is ultimately we have seen year-over-year costs of construction increases probably for the last 10 years, and it's pretty substantial, probably 15 to 20% increase regardless of brand. It's just the cost of construction is going up, period. And so the challenge that Ron's referring to is that if you rely on the low end of the franchise disclosure document, your actual costs come in higher. You may be underfunded if you anticipated a loan or paying cash for a lower project cost, and then all of a sudden it comes in $100,000 higher. The risk in that is that you have to come out of pocket with that, and then it depletes the cash. Again, in the spirit of the webinar, cash is king. Preserving it is really what you want to try to do. So how do you finance unit number 1? Pay cash or someone else's. Again, there's some pitfalls and challenges to that Ron mentioned, but it is obviously an option. Security-backed line of credit, if you have a large marketable securities account, you can borrow against that, similar to a margin account. You are at risk of the account going down in value and get a margin call. SBA loans are very common for this type of borrower or franchisee. It's probably the most common funding option available to you, and they're very attractive terms. It's the least risky loan that you can get. There's no covenants, etc. One option that you could also utilize is a 401k rollover, and ultimately you can take your current retirement accounts, invest into yourself as a business owner, either by funding the entire project with your retirement accounts or using less of your retirement accounts and combining that with another financing product. There are ways to do that without penalties, without tax liability. It has to be done properly to comply with IRS codes. So therefore, I would make sure you do it with the correct partner that makes sure it's done to keep you out of trouble. There are other options. One of them would be our ApplePie Capital Core product for select brands. We are able to offer financing for first-time franchisees with a conventional loan product. Again, we have probably 30, 40 different brands that we're able to do that for. It is unique and ultimately possibility depending on the franchise concept that you're in.
Now let's move up. Let's move up to the 2 to 5. You'll see this liquidity issue carry through. So many times we see folks burn through all their cash and not have the money left to put the down payment down on unit number 2. It's really a very important thing to preserve your liquidity where you can. And even if you work it right through the right people and getting an SBA loan, if you have a multiple unit commitment, they won't lock up your cash many times. In terms of risky financing, many of the online lenders, the merchant cash advance folks out there that advertise will give you money real quick, that real quick comes at a big cost. The APR will start with a 3 generally or higher. That would be 2 digits with a 3, not 3%. And the amortization is going to be 3 to 6 months, maybe 12. And you don't want to be hampering your existing unit cash flow by going to work for the merchant cash advance person. It's really not a good idea in most cases, in almost all cases. We also see people getting hung up on interest rates. If you're in growth mode, you want the most flexible capital. The most flexible capital almost always is not the cheapest capital. If you're so interest rate phobic that 1 point makes a difference as to whether you're going to open or not, think of the opportunity cost you're losing by not opening that unit. If you have existing unprofitable units, don't even try to grow. You're not going to grow your way into profitability. You need to fix that problem first, and then work on growing. Again, the big takeaway, you've heard it. If there's one thing you leave here with, it's preserve your cash.
And just to add one more point, and the opportunity cost of capital and looking at the lowest interest rate, many times a 5-year loan would ultimately have a lower interest rate than a 10-year loan would. And ultimately, the 5-year loan payment's roughly going to be double that of the 10-year loan. So again, if you're in growth mode, your monthly payment should match your cash flow. And a 5-year loan a lot of time puts too much stress on your cash flow. So consider the term is more important on the payment than the interest rate. So ways to finance this. SBAs is going to be available in this category, 2 to 5 units. ApplePie Capital Core. At this point, if you're an existing operator, we are able to open up the number of brands that we can finance with our core product because it's not a new anymore. You've got experience, so therefore we are a conventional lending option for you. Traditional conventional lenders that focus on franchise financing, depending on the brand, it's usually not available for you if you're less than 5 units. And because we have many people here on the webinar, there are some brands where conventional lenders do step in a little earlier, but a general rule of thumb is greater than 5 units would then be, you'd have access to traditional conventional financing from conventional franchise lenders.
Yeah, and just to add one more point, we're considering conventional lenders to be those that aren't taking your personal collateral. If they're taking your house and your vacation home and your children, you're going to get them to lend to you faster. We're considering lenders who lend in the franchise space who just take personal guarantees. Once you've hit 5 units, it's a different set of issues. Here's where you should really be leveraging the equity in your existing business to grow. Again, we can really help give you, and we'll show you later, a calculation tool that we have online that'll make it easy for you. Many times once you get larger, you do exclude all the small costs and working capital. You also need to be cognizant of the fact that you might have some remodel and refresh obligations on your existing units. The most important thing here, that's all kind of common sense, but read your loan agreements. If you don't understand your covenants, get someone to explain exactly what those covenants mean to you. We're now trying to help a few people that got caught in covenant calls where they've never missed a payment. You know, they're still making money, but they didn't hit one of those covenants, that 4-to-1 covenant or the 1.25-to-1 covenant. And now that really cheap loan became a more expensive loan because the bank wants to charge them $10,000 to waive that covenant. You really need to understand it once you're into that conventional world and you have covenants. Big takeaway here, again, you can grow generally at this point if you're not over-levered without reaching into your pocket. Your business should be able to fund your growth through existing equity and existing cash flows.
So in this bucket here, the options are more significant. Conventional franchise lenders typically are now interested in financing your projects. They usually come with the lowest interest rates, but they also have the least amount of flexibility. And where Ron was referencing the covenants, most of these loan agreements for this type of financing will have some type of debt service coverage or debt to EBITDA coverage, or even post-distribution coverage covenants, where in other words, they're restricting the amount of money you're able to take out of the business. Our ApplePie Capital Core product is still applicable in this scenario. We obviously would finance these as well. And the benefit of that, as Ron mentioned, in our core products specifically, we don't ever take a personal asset as collateral. We don't lien homes. We always take a personal guarantee and a corporate guarantee, but there's no personal assets attached to it. SBA at this point it could be a useful option depending on your scenario. You maybe have grown out of it at this point. Some good uses for this could be potentially acquisitions or ultimately real estate purchases. The SBA product is very attractive for real estate purchases. It typically requires the least amount of money down and has one of the longer amortizations. So it's a good fit still for real estate purchases, assuming that you have enough room left in the $5 million SBA cap.
Here's just all the products, looking at them side by side. If you're looking for a fast loan, SBA is generally not what you want to do. If you don't want to pledge personal collateral, you're really looking, conventional loans many times don't make you pledge personal collateral, but in some cases they do. If you want to do projection-based lending, that means you want to borrow money against future cash flows that you anticipate having. You're really limited to SBA and ApplePie. On the equipment side, if you're doing a refresh, many of those refreshes are based on initial testing showing a lift based on refreshing the unit. So that's why we put that in there. Lowest monthly payments. Usually lowest monthly payments doesn't equate to lowest interest rate. To Randy's point, it equates to longest term. So ApplePie Core and SBA offer 10-year terms without real estate. First unit financing, pretty obvious. And if you want to get a multi-unit commitment up front, you've either got to have a number of units and have a conventional lender involved, or you're going to us. SBA generally doesn't do that. And if you want to cover everything in one loan, you need to do some refreshes. You need to borrow money for a new unit, and you want to get rid of your SBA loan. That's a perfect use for an ApplePie loan.
So what are the first steps in creating your 2020 strategy? Define your goals. How many units would you like to open in the next 6 to 12 months? And then ultimately make sure you understand, are there also any refresh or remodel considerations that have to be accounted for? And so just know what your goals are, know what your cash outlay is, and get prepared. And the preparation means get your financial statements current, both personal and business. If you are looking to add 2 or 3, 4 units within the next 12 months, I recommend filing your tax returns on time without getting an extension. When you enter into an extension, many times you have 18 months before you have your most recent tax return, and that causes lenders pause if you're growing quickly. So file the tax returns on time without extension. Strategize with a professional, somebody that understands your brand, understands what your goals are, and has different tools in the tool shed to be able to get you from where you are today to the end of 2020 and beyond. Ultimately, forecasting cash flow, even if you're an existing franchisee where you know the current cash flow, if you're opening into a newer territory, and it's important for you to assess, does this territory look similar to my other territories, and do I have confidence that it will ultimately generate the same amount of revenue or EBITDA that my other locations have? Implement the strategy. Anybody that's been in consulting for a long time, their best and worst customer is somebody who you spent 6 weeks, 12 weeks with, and ultimately went through a lot of different strategies and talked a lot of stuff about it, but then it was never followed. This situation is very similar. Seek advice, figure out a strategy, and implement the strategy. Don't go wayward. And then post-transaction review. Ultimately, review what happened. You open a new location. Don't wait 3 to 5 months later to assess how did you meet. How did it compare to your projections? In month 1, did I compare well against my projections? And if I didn't, what do I need to do differently? And if I did, good. Then you're at least cross-checking it.
So how do you do it? One is you keep borrowing. The pluses of keep borrowing is that you still own 100% of your business, and once you amortize all that principal down, you have a huge cash cow, or you have something that you can sell and have a cash stake for your family. The downside is you're all in. You're risking what you already have to get more. You really need to be very confident in your existing team and your operations. So if you're going to use debt to grow as your sole method of growth, just keep those two things in mind. You also have to, and I'll throw this in on a macroeconomic issue, if we're looking at a little downturn, I would do some what-if scenarios. What if my sales went down by 9%? What if they went down by 5%? How would that affect my bottom line? We just got a question live. What about partner buyouts? They're great. They're great deals for banks to look at. We love partner buyouts, especially when the operating partner is buying out the passive partner. I don't know what your situation is, but that's something we should definitely talk about. In SBA, if you already own 10% of the business, you can buy the other 90% without any outlay of cash in many cases. In our core product, we can generally do 80% of it. So thank you. I'm glad we answered your question. So most important here, be confident in your existing operations.
Okay, so other ways to grow would be getting equity, meaning taking in cash from an outside party, potentially related or not, and giving them an ownership in your business to do so. Sometimes this is a good strategy. It helps you grow many times quicker. The downside is that ultimately they're getting a stake in both the profits at year end or potentially earlier, or whatever is agreed upon, but then also on the exit. So when you sell, they also get some of the benefit of your hard work in the exit. So it's a good tool to grow quickly. You just need to consider the downside of the exit strategy. Ron, one of the first points that Ron mentioned in the first slide that he went over was, what is your exit strategy? Circling, when you start entertaining equity investors, they're going to want to know your exit strategy, and you're going to want to know their exit strategy, and make sure you're in alignment. There's nothing wrong with growing this way. You just need to know at the end of the day, your efforts will be split with somebody else. Oops, sorry, Ron. I think
we both pushed the forward button. All right, we're going to kick it up a notch here because we want to make sure we get all this content out to you. So there's a hybrid way to do it, and that's just to bring in a minority partner and then use debt to lever with your minority partner. It's a good way to go. It's a very common way to go. Many times other franchisees within your same brand are the people that do these kinds of things. Just one big caveat, your minority partner might have to also personally guarantee debt, and those guarantees are always joint and several. They're not proportionate, so you're both on the hook for all the money. That could be a problem, and your minority partner might also have to go on the franchise agreement. So you want to make sure you get good advice there. But again, this is just using the other two strategies in combination to get yourself to grow instead of going all in one way or the other.
Acquisitions, we discussed this a little earlier. Growing by acquisitions is a good strategy. A lot of times you can buy them in bundles. You can buy groups within a contiguous location and get access to them quicker. The typical downside of acquisitions, assuming they're well performing, is they're at a higher cost many times than what it is to just open a new location. So how do you fund it? Number one is you could use your existing locations to fund all or part of the business acquisition. You could combine various financing options that we've discussed. You may be able to pull some equity out using a core loan, combine that with an SBA loan to fund the entire project at 100% financing. What's most important here is to make sure that when you are entering into the beginning stages of an acquisition or acquiring locations, you have somebody on your side that's reviewing the purchase price, what's the financing strategy, and how to help make it all work together. And that person, that outside perspective, could be a CPA, which many times are deal killers, not deal makers. Same thing with an attorney. Many times they're deal killers, not deal makers. Or somebody that's your financing partner that would have aligned interests that you do.
So we keep pushing the button at the same time. There's two kinds of acquisitions. One is units that are performing, and the other is units that are distressed. I'm just going to cover a couple of these things. The pros are all really kind of very commonsensical. A couple of the cons I want to focus on. One is franchisor ROFR. For those of you that don't know what that is, that's a right of first refusal. Almost every franchise agreement that we've seen, the franchisor has the right to step in and take the place of your buyer. You want to try and pre-clear that, or else you're going to do a lot of work for nothing. Deferred maintenance and potential remodel requirements. Many times franchisors will require the units to be brought up to brand standard at the time of the transaction or within 6 months of the transaction, something you want to make sure you have. Their reputation, if they're performing, it's probably a good one. But culture is a big thing. And, especially if you're buying from a family-owned operation versus a professionally managed operation, not that there's a big difference sometimes, but sometimes they just have their whole family in the business, and it makes it a different environment. And we've seen some acquisitions go really poorly when there's not a good culture fit. So you want to try and make sure you cover that.
Yeah, and I think in a distressed situation, one of the biggest, I would say, building on Ron's point on the culture, many times in a distressed situation, the unit's not performing well because of potentially poor culture. And so going in there with the mindset that you have to maybe make some changes with either the mindset of the operators or ultimately making some changes overall in staffing is where we see a lot of attention being spent by operators when they acquire distressed locations. Deferred maintenance, many times when there is a distressed situation, the franchisees are potentially not doing as well as what they had hoped, so therefore the cash flow is less. Therefore, they've put off replacing important equipment or even just general maintenance overall. So therefore, you want to assess the cost of that and anticipate that there's going to be problems as you enter into a distressed location. I'll let you drive the fast forward button, Ron. That way we don't double click.
Thanks. Got it. So when you're buying a performing, this is kind of a little due diligence list. I'm not going to cover it all here because we'll be here for 2 hours if we do that. But generally you need 10 to 20% to acquire performing units. You can use your existing equity to do that. Senior debt lenders are generally looking at 3.5 to 4 times to go back to that covenant conversation Randy had with everyone. So if you're paying over that, the rest of that's going to be your down payment. You're going to have a down payment regardless. Sometimes you can get seller financing. In this banking environment today, it's not generally needed. But if there is a tightening, seller financing might, reappear as a strategy. But this just gives you the framework of what you need to look at. I'll just call out one thing for those membership-based businesses with prepaid services and gift cards. That's always a negotiation in every transaction. You have to understand exactly how that works. And if you're going to a local bank to get that done, I can guarantee you they're not going to understand how that works. So you want to make sure you have a lender that understands that brand.
Financing or distressed acquisitions, ultimately, many times these are financed by you. In other words, either cash or the equity that you've built within your business. A business that's losing $50,000 to $100,000, it really, in the way a cash flow lender reviews that, is a drain, not a benefit. There are potential ways for you to recast if you're an existing franchisee. There's a way to recast the financial performance based on how your current operations are running. But as a new franchisee trying to buy a distressed location, there's no basis for a lender to review that. So these are very challenging, especially as a younger franchisee, to get financing for. I guess ultimately the takeaway from this is that if you're an existing franchisee, you could utilize your embedded equity to help finance this. You just have to assess, is the drain from this business too hard on or too much of a stress on my current operations? New franchisees likely would have to pay cash for this. All the other points that Ron mentioned and the due diligence would still be applicable, probably even more than the well-performing locations.
Remodels, reimages, we've mentioned it a whole lot. We're seeing a lot of this happening now, where brands are basically saying we're changing to a new image, especially in food, fewer seats and more kitchen room to do delivery. It's happening all over the place. You want to make sure that when that comes to you, and we have a bunch of larger multi-unit franchisees here, you generally get a prepackaged finance offer with that. Might not make sense. It might make sense. You want to get help. The big takeaway here is have somebody holistically look at your entire operation and help you with the financing strategy to cover these remodels and reimages. One point that I'll cover is if you're going to close for a week, you don't want to lose your team because it took you a long time to get your team, and I guarantee you they'll go out and get other jobs with no unemployment out there. So I want to make sure you have enough working capital to cover, especially if you're going to be closing units for 5 days and you're going to close each unit. You have 5 units, you're going to do it in consecutive weeks. You want to make sure you don't lose your team. Move them to your other units or just pay them.
So refinance, recapitalize, or both. So what is the difference between refinance and recapitalize? Refinance really just means you're taking your current debt and restructuring it without adding additional debt. Maybe it's to lower your interest rate, lengthen the amortization, to reduce your monthly payment. In some instances, we've seen borrowers do this to shrink their term because they want to exhaust the debt quicker, and really we're looking for a lower interest rate. Recapitalize means that you are taking money out of your current, you're refinancing and taking money out of your current business for business purposes. So a couple of things that we've mentioned here would be a good example of a recapitalization, using money to acquire a distressed location, or using money for a down payment on future growth, using money to fund new locations, using money to do a remodel. All of those would be good uses of recapitalization. Kind of stepping away from that, releasing personal collateral. Ron mentioned SBA lenders many times take a lien on your home, so it might be a good opportunity to look at a refinance to take that collateral off of your personal residence or marketable securities, whichever one may be attached to it. The benefit of the recap is to open stores faster. You're getting an advanced proposal or commitment based on your current cash flows to kind of give you confidence in adding units quicker and with minimal cash out of pocket. For some brands that have a high cost of entry, it may be a good opportunity to refinance your existing locations into a conventional loan because they had SBA debt, and ultimately it frees up SBA eligibility. The SBA allows up to $5 million in outstanding loans with you, so if you're up against that cap, an SBA is still an attractive option for your brand, but you're up against the cap, you could refinance the stores with historical performance and then free up more eligibility. Probably the last two bullet points would be eliminate interest rate risk. As of today, rates are cycling downward. Obviously, over the last 3 years, we had upward trends. So it just eliminates risk by refinancing into a fixed rate product. It gives you some confidence that your monthly payment will remain the same for the life of the loan. And then last piece is just make your life easier. Consolidate all your debt into one loan. That way you don't have 4 or 5 different loans standing out there.
So if you're looking for an exit, how do you do it? Selling your business does not mean you're a failure. My wife and I were Goddard School franchisees. We sold it, and it was a great experience. Where do you look for buyers? You can either get a business broker. You could talk to other franchisees. Don't try to do it yourself unless you're just going to talk to other franchisees. Figure out what your business is worth. It's pretty easy math. If you have a question, give us a call or get an actual professional evaluation. But know that your business is worth what the market's willing to pay for it. Answering that question with, I need to retire with $2 million is not what your business is worth. We talked about how lenders are going to look at it. They're going to lend 3.5 to 4 times. So anything over that is coming out of the buyer's pocket or their equity. And you want to make sure that it's reasonable. And then what is the franchisor's involvement? Are they going to have to qualify your buyer? Does your buyer meet the minimum requirements to become a franchisee? Because that's what the franchisor is looking at. So if it's your manager looking to buy your unit, you want to talk to your franchisor in the beginning and make sure that they'll actually approve that person. The other factor here is also the landlord. You want to make sure you talk to the landlord to make sure that they'll take over the lease, because if you're selling, you don't want to stay on the lease personally.
We did have a question pop up, Ron. It says, do you have a portfolio of lenders if you can't do the deal? The short answer is yes. We actually are product agnostic. We are on your side looking at your current situation and assessing what various options apply and what makes most sense for you, and discuss that with you and figure out what's the best strategy and be in alignment on that. So what can you do now to prepare, but can you do now in Q4 to prepare? Show your cash flow. Make sure your financial statements are clean. Make sure that they are consistent. Make sure that they are clear. Eliminate fluff in there. And what I mean by fluff is take out personal expenses. Your gym membership, your cell phones are probably okay. Your brother-in-law's car payment, etc. Take all of the fluff out of there and have it be just representative of the business. Saving money in tax is probably the worst thing you can do if you're just putting kind of fluff expenses in there. Make sure they're legitimate business expenses, and that will help expedite 2 things: your growth, and also will maximize your exit strategy if you want to sell. And I would just make sure that your financials are up to date, current, and clean. Do not get an extension. Be prepared to submit your financials quickly to your accountant, CPA, whoever it is, to prepare your tax returns.
So what should a capital markets partner do for you? First, they have to understand franchise lending. Many bankers, your personal banker probably doesn't. They're going to either give it to someone else, or they might not understand your brand. A lot of the folks on this call are in regional brands or brands that aren't buying time on college football, so not everybody knows what they are. Provide customized financing options, to Randy's last point. We think we do a really good job, if we can't do it, of finding someone else who can. And someone who's focused on your long-term goals. If you're we kind of break it up into two buckets, hunter bucket and farmer bucket. If you're a hunter and you're still growing, there's a different set of debt that you want to go after versus when you're farming and you just want to get the lowest rate and you don't care about all those covenants because your business is just operating. You're not stressing it with growth. So you want to make sure that you get a capital markets partner on your side. That's what we do. We're here to help.
So what's the best way to leverage our team to help? Ultimately, we are, as we kind of mentioned, we are somewhere in between the franchisees and the lending platforms, other financing products. We will contact us and we will work with you on your strategy and bring all of those pieces together. Really applying for financing many times at 2 or 3 different options at one time is time consuming for you. Also, many times you want to operate your business. You don't want to spend the time dealing with lenders. We help manage that for you on your side. We're professional representation for you through either our core product or funding partners. And ultimately, we have several different tools in the tool shed to help get you there.
I want to just skip ahead here to the tool that we discussed earlier. You see the URL at the top, applepiecapital.com/grow. This tool will bring to you the ability for you to just enter in a few numbers, and like a mortgage calculator, it'll tell you how much money you can borrow. EBITDA, if you don't know what that means, you need to know what that means. It is my license plate on my car. I always get a good laugh when I'm live doing that, but it's the truth. And you see we're looking for the last 6 months if you're entering this. The reason we do that is if you're in growth mode, your last 6 months are generally better than your last 12 unless you're in a seasonal business. You fill in the left side and you'll find out what your borrowing power is on the right. And then we can engage with you and put a plan together to figure out how you can best serve your growth needs. With that, we have 2 minutes left for some questions. I'm looking to see if there's anyone else that's typed one in. One of the questions we have here is requirements to fund future development. There's 2 ways to do that. With a conventional lender, you can get what's called a development line of credit. It's kind of a false flag, though, because it's all based on your existing cash flow. You're in a brand where that's very common. We're able to actually take the equity you have in your business and put that towards your growth and then do pro forma lending for your growth without having to use SBA. So we should definitely have a conversation to see how that works for you personally. And when with financing has been such a challenge, how can we go without financial support? Call us. We're here to help you. You're in one of the brands that we work with on a regular basis. How to start the process? Very simple. Just go to applepiecapital.com and there's a button that says Get Started. It'll get routed to the right person for your brand. We have an approach where each brand has a team, and on each team there's someone experienced in first-time units, second-time 2 to 3, 2 to 4, and then greater than 4. So we're here to help you as much as we can. And with that, I think I covered all of the questions that we got. Randy, did I miss any?
I see one here. This is, what if you want to get involved in a different franchise? So it really simply said is the person's in one franchise and wants to buy into a different franchise. It depends on the funding option. Some lenders are hesitant to do that as a first entry into that new brand. Our core product's a good use for that. We've done that many times. And so I would recommend you call us to see if there's something that we could help with.
Great.
I think that was it, really.
Well, we're right at the top of the hour now. We want to respect your time. So if you have any other questions, you see how to reach out to us. We're here. We're ready to talk whenever you are. Thank you all for giving us an hour of your day today.